topic we're going to be discussing is a very increasing relevant, certainly increasingly topical area of the whole active-passive debate. It's certainly one that's been sort of permeating for many years now, but in the last year or two really seems to have grown some significant legs if you sort of look at where assets, not only locally but right around the world, have been flowing. There's certainly been some big skews in that area. Now, there certainly can be some wide, differing, sometimes even polarising views around this debate to investment selection. And so we're going to explore many of those throughout this session today. So to introduce and moderate today's session, we've got Tim Wong, Associate Director in our Manager Research team. So Tim, over to you.
Thanks, Tim. So joining me up on stage to my left is Bianca Rose, who's a Senior Portfolio Manager in Morningstar's Investment Management Division, as well as Jeffrey Johnson, who's Head of the Investment Strategy Group at Vanguard, to discuss these topics. So while you're all getting seated, just appreciate it if you could whip out your phones and tablets just to have a look at this particular poll question. So the four options there for the question is, I use passive strategies in my portfolio because of 1, cost and simplicity, 2, whether you think active strategies haven't actually performed well enough to justify their state in your portfolio. You may use passive strategies for tactically adjusting, say, your asset allocations, or 4, you don't use passive strategies at all. So if you wouldn't mind just having a go at answering those questions, and we'll check up on those answers in a minute. But as Tim mentioned, one of the interesting phenomena we have seen relates to flows. So the chart you can see here shows the flows by calendar year over the last circa 10, 12 years, split between active and passive strategies, and this is in the US. And you can really see the red bars are passive flows into passive funds, and that really has dominated flows compared to active funds over the last sort of 3 to 4 years, at least in the US. And that's really garnered a lot of media attention in terms of what impact that necessarily will have. In Australia, there's been a somewhat similar experience. Clearly, the market is nowhere near as large, and the magnitude of those numbers is not going to be anywhere near as great. But we have seen, as you can see on the chart on the left, that is in the sort of total Australian market, that passive funds have garnered a decent chunk of the flows in the last 2 to 3 years, especially compared to active strategies. And the chart on the right is specifically relating to Australian large cap equity funds. There's been obviously a lot of outflows in active strategies, whereas passive strategies have generally trodden water or grown a bit. Now, I do note that in 2016, some of those numbers for passive strategies are actually a little bit understated because there have been some flows out of some Vanguard pooled funds, and they've actually been going into some Vanguard separately managed accounts. So that's actually a little bit understated in 2016 for passive. But nonetheless, you can see that certainly in those asset classes, or in the Australian equities case, there has been that continuation of that trend. But it's not really the case in fixed interest. You can see that active managers have really garnered a large chunk of share of flows over the last sort of 3 to 4 years. Probably as in light of a lot of concerns people may have about how an indexing style approach does fare when yields are so low. Now, if we were just able to flick over to the actual results of our initial poll question, and bring that up on screen, please. And you can clearly see that it really comes down to, well, cost, which is not surprising, is the big factor for why a lot of you are choosing to use passive strategies. Interestingly enough, there's quite a large number of you who don't use passive strategies at all, which will be something that we'll definitely look to touch on. And it's probably, I think it's interesting that, not many people are citing performance as being a reason for why they're choosing passive strategies. So that's an interesting outcome there. And on that point about performance, if we were just to switch over back to the presentation, bring up another poll question, if you wouldn't mind again. I'd just like to know what you guys are thinking, which asset class actually makes the most sense for choosing a passive strategy. Is it Australian equities, global equities? Is it fixed interest, listed property, or something else? And while you do that, we'll just show that some figures on the performance side of things, about where active strategies, how they've fared against their respective benchmarks. And really, from what we've seen over a really sustained period of time, so this is up to sort of the last 15 years up to March this year. Say in global equities, which is the chart on the left, you can see that most active managers have generally struggled to meet or beat their index as represented by the MSCI World ex-Australia benchmark, and that's over pretty sustained periods, over short and medium and long-term periods. In small caps, it's completely the reverse. It's been really hard to be an active manager and actually underperform the benchmark. You had to have done something pretty wrong, but last year was perhaps a bit of an exception. And then, I guess, when we look at it at the multi-sector level, so this is sort of the growth allocation, the growth style allocation multi-asset funds, we found that over most sort of short and longer term periods, active managers have really struggled to match the benchmark. And in this case, the benchmark is represented by the weighted average of the asset allocations in this peer group against the actual respective asset class benchmarks. And you can clearly see the blue line is well short of the red line over all those time periods. In our view, that really highlights the impact of costs, and also it's quite difficult to be good at lots of different asset classes and effectively asset allocate across different asset classes as well. So if we're just to bring up the results for the second poll question, please. So you can see there that most of you think that listed property is most sensible for passive investing, which probably makes sense, especially in A-REITs when the sector's, 12, 13 A-REITs, dominated by a handful of other A-REITs in the market. Global equities is, interestingly enough, is quite high up there on the list as well. So, with all that in mind, let's start with a question to Jeff. And what do you think, which asset class, in your view, makes the most sense for being passively invested?
Sure. Thanks, Tim. Thanks, Bianca, for inviting Vanguard to the stage. Really happy to be having the chance to talk to all of you about this very important topic, increasingly important topic. The question is around which asset class do we believe passive or active makes the most sense? And I guess my short answer to that is I don't really believe that there are any shortcuts necessarily in it, and really don't agree with the idea that active or passive works any better or worse in any one asset class all the time. We think it's far more complex than that. For most investors, most of the time, we think that passive investing can play a core part of their portfolio for a variety of pretty well documented reasons around diversification, low cost, transparency, relative predictability of returns, allowing investors to focus on other aspects of portfolio construction. We do believe that active can play a role for certain investors, and our money is where our mouth is on that. Vanguard has today about a third of our assets globally that are actively managed. And in fact, our first 11 funds, when we were formed in 1975, were all actively managed. So it's part of our DNA, but a core part of our belief when it comes to active is that the right answer is very much conditional for each investor based on their unique characteristics and preferences with respect to their portfolio. There's pretty good evidence over time that across asset classes, passive has been outperforming. There are a couple of exceptions, and Tim pointed out Australian small caps. There's also pretty good evidence over time that active is getting more difficult as more and more people are competing for what may be a diminishing supply of alpha. So for us, I don't really think I would answer it in terms of which asset class we should be active with. I think it comes down to what sort of cost constraints does each investor have that they're focused on? What are your alpha expectations? What sort of resources do you have at your disposal to commit to the due diligence exercise to find those rare few active managers that can outperform consistently over time?
Sure. Bianca, do you have any thoughts or agree, disagree?
So from our perspective, we see that there's a role for both, but clearly in terms of asset classes, we think there are certain asset classes that lend themselves more to passive. And like the audience poll, we would say Australian listed property really sits in that kind of domain. The main reason is we think that there's not many securities, there's not much breadth of opportunities for an active manager to make calls on, and so there is really limited alpha opportunities, if you like. There are ways to go about listed property differently, and you can tailor things for that concentrated asset class. Unfortunately, most of the active managers tend to be quite index hugging, so do not justify the fees that you have to pay in Australian listed property, hence why we think it makes sense to go passive in Australian listed property.
Sure thing. Cool.
In some of these, asset categories where many investors will look to active to play a larger role in their portfolio. Sometimes you'll hear examples about small caps. Sometimes you'll hear examples about emerging markets. Listed property, I think, is another one. It may be true that there are more of those opportunities. What we've also observed, and the data has really supported this over time, is that inside those categories, there's also far greater dispersion of results. So there's a wider degree of outcomes that you'll experience in terms of those managers that operate in those spaces. So on one hand, that does create opportunity. On the other hand, it elevates the need for deep, committed resources dedicated to performing the ongoing due diligence, evaluating these managers, staying on top of them over time, because with that opportunity on the upside clearly comes also with significant downside risk in those same categories that also, by the way, happen to be some of the categories that are just a bit more capacity constrained. And we know that as active managers have success, assets under management can grow. That can limit their universe and curtail their ability to generate that same amount of alpha that they have in the past. So there's sort of those trade-offs that we as investors have to balance when going into those so-called less efficient categories.
Okay. On the flip side, I mean, it's probably a question best answered by you, Bianca, but where do you think passive strategies make the least sense?
So obviously areas that are probably opposite to Australian listed property, where there's lots of breadth of opportunities, where you have a high conviction manager that offers reasonable fees. So I think two things, fees and got to be different to the benchmark. So in our experience, global equities is a great area. Yes, I agree with Jeffrey on range of outcomes. Can be really different range of outcomes, but I think that's, if you're going to pay your fee budget somewhere, that's where you want to pay it, where there is a big difference between the first quartile and the fourth quartile. And if you actually think you have a skill set in picking active managers, that's where you should go, as opposed to other areas where the range of outcomes may not make much difference. So in global equity space, we think it's important to pick a high conviction manager. And when you showed the results there of global equity managers as an average failing to beat the benchmark, we'd argue that there are probably a lot of closet indexes out there. And because it is a capacity constrained area for the truly active managers, provided they're charging reasonable fees, we do feel it's possible over the long term to outperform.
Cool. I mean, what do you think about the case for fixed interest? So we saw that there's a lot of money going into active fixed interest strategies. There's obviously a lot of headline concerns about fixed interest benchmarks. Do you agree with that? Do you agree with that take?
So in terms of global fixed income, we think it makes sense to go active, and we are quite, again, like your polls suggest in terms of, or the graphs suggest in terms of flow activity to fixed income. When you think of where the Barclays Global Aggregate Index sits today in terms of duration, it's sitting at 7 years. The yield is just above 1% now. In terms of risk-reward trade-off, you have to think, where does that go from here? And so we think it makes sense to appoint an active manager there in terms of, A, they can take the duration bet, they can also take credit bets, they can take FX bets. There's lots of breadth for them to take opportunities there. So that's our view on it.
I think I'd just offer a couple points on that. First point is, thrilled to see the cash flows going to fixed interest as a category. Given the prevailing narrative in the marketplace over the last several years around concerns about low rates and eventually higher rates and debt levels globally, too much of the narrative in our view has been focused on avoiding bonds altogether as an asset class. We believe they have a core role in investors' portfolios, precisely for days like today when overnight you saw a big correction in U.S. equity markets. Time and time again over the last couple of years, investors have been rewarded for holding that defensive allocation in their portfolio. So kudos to all investors for continuing to allocate to the asset class, number one. In terms of the active-passive discussion here, we believe that investors ought to have fixed income in their portfolio for that downside protection and those defensive measures, and because it tends not to correlate too well with equities. The more we go active in that asset class, the more we run the risk of altering the character of that asset class that we've introduced into the portfolio for those defensive reasons and for those diversification purposes. So certainly there are active managers in that space that have performed well over time, but this is where cost has a particularly key role in the discussion. When you are talking about an asset class that yields 1%, when you are talking about an asset class that on a 5-year basis, there might be 100 basis points that separates your top quartile from bottom quartile manager, the fee differential there can consume a significant amount of your expected return on the asset class. So we have to be very, very careful with that fee that we allocate to fixed interest. Now, in terms of how investors construct their fixed interest portfolios, increasingly globally, you have a choice. You have a choice between whether you go with an active manager that might reposition the bond portfolio maybe from a duration standpoint or often from a credit standpoint to pick up yield. So that's one choice. The second choice is to take advantage of increasingly targeted benchmarks that give you exposure to those points of view. Today, we can choose to commit our fixed interest portfolio to a passive short-term fund or a passive credit-oriented fund. And in many cases, what the analysis is bearing is that active managers with those sort of structural active tilts to either short-term or credit, in many cases, again, are having difficult times keeping up with those tailored benchmarks that have those structured tilts embedded in them. So, to the extent that investors are committing to active in the fixed interest space, I would encourage them to compare those active portfolios to passive benchmarks that really embody many of those same built-in tilts.
Yeah, and in terms of tilts within the fixed income, we have looked at EM debt to that point about tailoring, where we may employ passive and active in that space if we think the valuation opportunity looks interesting.
Cool. Jeff, you mentioned the volatility that has arisen. It's quite pertinent overnight. One of the common criticisms about passive strategies is that they may inherently provide you're just following the market. Whether it's up or down, you don't have any real sort of downside protection. Obviously, that's more on the equity side of things. How do you respond to that sort of criticism?
Well, I guess we're here talking today about active and passive in investors' portfolios, and Tim started by showing the flows over the last 10 or 12 years, and clearly globally those flows are tilting towards more passive strategies, and we think one of the reasons why we're having that conversation today and reflecting upon that wave of investor enthusiasm around passive is that during more of the down markets, bear markets over the last 15 years, active strategies have, by and large, disappointed investors. And we don't believe that it's true that during the tech wreck, for example, active really shone. And the same was true globally during the global financial crisis. So by and large, passive has not harmed investors to the same extent during those down markets over time.
Bianca, do you agree with that?
I think that could be true of the average experience. Again, I would say there's obviously a difference of where you've done the due diligence on your active manager, and again, that's where it comes down to have you picked that better performing manager. So I think that may be true of the average, but I'm not sure it's necessarily true of necessarily of experienced kind of allocators, if you like. And I think the other thing I would say is that to the point about active versus passive, I mean, it does go in cycles in terms of active alpha to passive, and we've seen that over the last sort of 10 years, the value managers have really struggled. That obviously goes through the numbers, but it is a cycle of active managers in terms of percentage is probably at the lowest level in terms of alpha versus passive today. So it will ebb and flow with up and down markets, and it isn't a constant underperformance at the levels that it is today.
I would totally agree with that point. I mean, you know, the experience of active and passive does go through cycles. You know, we're at a point right now in that cycle where, you know, active has had a really hard time. I'm not sure that's always necessarily going to be the case, but I think what I would say is that there's pretty good evidence that it is getting harder for active. Today we have tools, we have more data than ever, we have technologies that allow us to zero in and really understand the true characteristics and exposures in our active portfolios. And on the other hand, we have an explosion of index products and ETFs, some of which are smart beta or strategic beta or factor oriented, that allow us in many cases to, for a very low cost, replicate some of those same sort of beta or factor exposures that you would find in a traditional active manager. So having that opportunity to either replicate those exposures or substitute them, we think is making life harder for active managers, and that might be a structural trend in this industry.
Just on the kind of topic about, you know, the topic was finding order in disorder. This trend towards kind of capital flows being invested in sort of strategic beta products, do you think that that's maybe creating some areas of excessive mispricing or excessive capital flows that are kind of creating dislocations in the market? Do you think it's necessarily being used appropriately? That's for Jeff, if you might be interested in trying that.
Yeah, I mean, I think it's kind of interesting. There might be a little bit of a role reversal going on in the market today. I mean, many people have traditionally thought of passive as being a set it, forget it, buy and hold type strategy, and certainly that is true for many passive benchmarks and passive funds and ETFs. But where you've really seen the product growth in the passive space over the last 5 years would be in more narrowly focused niche categories. Today you can find a passive fund or ETF targeting just about any area of the market, sometimes long, sometimes short, sometimes neutral. There's really limitless choice, and it is capturing a growing share of flows going into passive. We believe that most investors are, you know, allocating to those types of products with a very active point of view. So you know, the investment decision remains active in nature. How it is implemented might be a little bit more passive or rules-based. But what's happening is each of those underlying, you know, more narrow segments of the market, maybe niche segments of the market, they have big time cycles in performance relative to broad market strategies, and that is going to you know, help maintain some of the efficiencies and in our point of view, price discovery in the market.
Yeah. Cool. I would agree there, and completely we do use tailored positions, so our valuation-driven asset allocation process is all about finding those niche areas where we think that there is a pricing opportunity for us to move into, and so it's been a great thing that there's more and more choice, I guess, in terms of instruments for us to use. And to your point about smart beta, I think it makes sense if it has a fundamental basis to it. But I think like any particular style or investment approach, you do have to watch for crowding in there because it's never a good thing to be sitting on a non-contrarian trade when the tide turns.
Are there any obvious instances in your view of some crowded trades?
I think at times different things, but we have seen minimum variance, definitely ebb and flow. And then, you know, it's more about 10 years ago with quant managers and the value and momentum, and a lot of managers were in crowded trades, and quite a few got caught out when there were, I guess, technical foreselling by certain quant managers, and you found a whole other wave of quant managers getting hit by the same thing. So we have definitely seen it before.
So we've seen that a lot of the people in the audience are using passive strategies for cost reasons. Do you think that's perhaps a bit too narrowly focused? Or is it perhaps disregarding some other more important factors in that kind of approach?
It depends how it's used. So it depends if it is used in a narrow sense, if it's used in a broad sense as a core and satellite, as long as I think people are very targeted in when they're thinking about that fee, that it's just not the lowest fee and that it's in the realms of the fee budget. So, fees are a finite resource, so you have to think about where you spend it. And so we do think about passive and active as like both having a role. But we don't think cost is the only consideration of, okay, we just have to go for the lowest cost. It's a weighing act, if you like.
Sure.
It's possible to have both. I mean, it is possible to obtain low cost and active management together. I mean, and it should be possible. There are economies of scale to be had in this industry. So I would look for active managers with scale to be out there at a reasonable cost. And for those investors who are inclined to pursue alpha, there are ways to improve your odds of success. You need to be exceptionally patient. You need to be exceptionally focused on performing what can be extensive due diligence exercises. We need to probably avoid the tendency to take shortcuts, looking at only certain categories or only active managers at certain parts of the cycle. But clearly there can be a role for active, but it has to be low cost and it has to be paired with top talent and patient investors, because we know that even those best investors that have outperformed over time go through extended stretches of underperformance, and sometimes the biggest issue to manage is the behavioral aspect, where we all find ourselves included, tempted to abandon a successful active strategy when it goes through those inevitable periods when it's suffering or out of favor.
Just a reminder, if you've got any questions, please submit them through the app. We'll probably be going through the audience questions fairly shortly. Just interested, Bianca, in your thoughts about kind of the impact of the potential impact, at least on the sort of push for passive strategies. Have you been seeing many active managers look to try and compete on costs? Is that necessarily a good thing? Could you see a scenario where there was almost a hollowing out potentially of staffing and that sort of effect on the active side, and what implications that may have for you as an investor?
Yeah, I don't think I'll see a hollowing out of active management teams. It's more just whether they're going to shut up shop, if you like, as opposed to reduce resources. It's probably like, and you've seen it with BlackRock. They've closed some of their active teams and they've kept some active teams. In general, I would say that managers today are a lot more open to the discussion about cutting fees, but not all managers. Those managers that already have fairly low fees, they're not going to, look at it. I'd say it's the guys that have fairly high fees. Or another phenomenon we're seeing is managers coming to us and saying, do you want a lower fee but with a performance fee structure? Now, if you have picked a good manager, and particularly when they've underperformed and you know that they're probably about to outperform, I'd probably say it's not a good strategy to cut the fee and go to a lower management fee and performance fee structure. But we are having, lots of those sorts of discussions raised with us, if you like. But I think always having the yardstick of passive as a low-cost kind of benchmark or yardstick is always a good thing for the industry and always a good thing for us to have when we're talking with active managers.
And it's hard to argue with alignment. So nothing could be more aligned, to Bianca's point, than an investor and a manager who both benefit if the strategy outperforms. So we see that alignment embodied in those sorts of performance fees and performance incentives, where if the manager wins and makes good decisions actively, the investor wins, and the fee reflects that.
Sure. Bianca, you mentioned earlier that MIM, or Morningstar Investment Management, uses kind of passive strategies and strategic beta strategies in kind of a tactical fashion. I mean, how do you try and make sure those sorts of decisions are truly repeatable, as opposed to potentially just trying to time the market in any given instance?
Yeah, I'm not sure if we're trying to necessarily time the market. We are using, I guess, our valuation approach to say where we think there's a pricing opportunity, if you like, and then we will maybe use an ETF, so a passive ETF, to access that opportunity, and then we'll say, okay, let's do some research, and then do we want to tailor that, opportunity? So a classic example would be even Japan in 2012. We saw that the valuations had got really low. We wanted to access that market, so we said, okay, we will go passive there, and then we switched our exposure to an active manager where we felt that the active manager was employed to play the corporate governance change trend, where we felt like a passive couldn't really capture that part. Other times we've gone passive where it's a particular sector within a region where we again see a valuation opportunity, and then we'll say, okay, do we need to go direct holdings here and think about where we want to play that in the chain. And we also use it obviously for cash flow activity. So futures, passively managed, we use them all the time. We might use ETFs if they're quite cheap. So we've used a fair few of Vanguard's products in our multi-asset funds for cash flow activity as well.
Cool. Just a question for you, Jeff. There's been mentioned about how there are a lot of objectives-based mandates and goals-based portfolios that are out there, people thinking about trying to generate a real return or deliver some sort of income stream for themselves out of their multi-asset portfolios. How do the index funds fit in that kind of framework?
Not sure they fit in that framework any differently than traditional active strategies. Index through a broad variety of domestic, global equity index strategies, fixed interest strategies, property if you'd like to include that, tilts through factors or targeted beta exposures. Professional asset allocators today can use all of those building blocks or ingredients, if you will, to meet various objectives, whether it's an inflation-linked target like CPI plus 4, or a more absolute return target of 5 or 6% per year. I think in that case the homework rests with those in capital markets functions who are trying to understand the correlations between the asset classes, the expected returns of those asset classes, and formulate a portfolio that's most likely to meet those. Now, in some ways, that passive solution ought to be the starting point for many investors. From there, if your capital market expectations are correct, and you'd like to raise the odds of success, you might substitute active strategies in place of passive strategies to meet those particular goals. But you also have to recognize that your range of outcomes now has also just widened, and you might outperform CPI plus 4%, but you might also underperform CPI plus 4%. And each investor needs to reflect upon, how important are those trade-offs, what are the consequences if we fail to achieve those objectives, and think about the appropriate active-passive mix for themselves based on that reflection.
Would you echo those sentiments?
So many people talk these days about low return world, and everybody hears this concept, but I think it is very clear in these CPI plus products that, to us anyway, you have to go passive and active, a combination. Passive because you've got your fee and kind of low fees, so you can spend that elsewhere in active, but we think that it's getting harder just to do the standard thing to achieve these return targets. In this low return world with markets going up and so on, it's very hard to achieve these absolute returns. So I think you do have to do more for it, and it doesn't mean some active management has to be there in our opinion.
And to your point, we did see earlier one of the poll questions was about where the audience thinks which sort of asset classes they're most amenable to, and alternatives came up as being quite prominent. Jeff, obviously alternatives doesn't quite fit in the sort of passive framework. How do you kind of respond to those sort of concerns, and how do alternatives fit and in that sort of asset allocation framework?
Well, now we're talking about a whole different set of asset classes and considerations there. Alternatives, we've seen growing allocation towards from many institutional investors. some of that was in response to success that some very large institutions and endowments had with hedge funds and private assets in the early 2000s. Unfortunately, what we've also observed there is that for many, alternatives have disappointed. It is sort of like active management on steroids, where you have the same cost challenges, you have the same transparency challenges, you have the same manager due diligence challenges, and in most alternatives categories, even wider dispersion of outcomes. So it elevates the need for due diligence on the front end. In general, what we found is that really only that top decile of institutions with the most sophisticated investment teams, the deepest teams, the most resources, the best access to the top alternatives managers have really been able to add value consistently over time there. So we would treat that asset class generally with an abundance of caution.
Sure. We'll just open it up to some questions from the audience. So if you've got any questions, please raise your hand and call for a mic. One question we got here from the audience is, should active manager fees be set at the same level as index fund fees and charge performance fees only on the alpha created? Bianca.
I think it, again, will depend on the space. And I say that because some of our active managers in our stable are comparatively low fees compared to passive managers. And I know that does seem inconceivable to the audience, but it can definitely be the case that you can have very modest fees for active managers. So they can be, a little bit higher than the index managers, and then there is a performance fee component. And if you have chosen a very good active manager, you end up paying quite a bit. And so when you have identified a good manager, and I've raised this before, sometimes it doesn't make sense to go performance fee, even though it gives you alignment of interest. It's because they are a very good manager and they know it, and they want to charge you more fees for it. And so you just have to be careful. But, I'm all for the alignment of interest as well.
Sure. Jeff, do you have anything to add?
Yeah, I guess I would just share our experience. I mentioned earlier about a third of our assets are actively managed. About half of that active book of business is in externally sub-advised strategies, where Vanguard has partnered with about 30 firms around the world to manage active equity strategies for us. Almost all of them have performance fees, where a base fee is paid, and then based on a sliding scale of relative performance compared to an agreed upon benchmark, that fee is either going to go up or down based on how well the end investor is doing. So I see that as a highly aligned model.
Sure. Are there any questions out there in the crowd? I can't see any. Just another question from the audience, and Jeff, it sounds like you might need to do a bit more convincing for this person. If a client's stated goal is to outperform cash or term deposits on a regular basis, why does it make sense to add passive exposures with no downside protection versus active managers who have been able to protect capital on the downside? Clients don't hunt alpha, they hunt positive returns.
So now we're talking about an active strategy. So, in that sort of case, if the objective is to minimize downside risk and to minimize exposure to a declining market, an active strategy might be able to achieve that. What becomes critically important in this case is our conviction level and the due diligence to demonstrate that we believe that there's a high odd, that there are high odds that manager is going to be able to achieve that consistently over time.
Okay, and probably no questions out there. Just one final one through the poll, and I'll just try and find one. Vanguard has introduced active portfolios to Australia. What's your rationale, Jeff?
A couple points. One, it's in our DNA. So our first 11 funds, when we were formed as an organization in 1975, were actively managed. So it's been something we've done for the entirety of our history. We believe that it is possible to offer active at a low cost, and that provides some modest amount of outperformance over time. You have to be extremely disciplined and careful about what sort of strategies you're going after, and you clearly have to be very low cost in nature. A lot of people have asked us why it took us so long. We've been in Australia for more than 20 years. Why now? The answer to that is we've globalized our investment team in a way over the last 6-7 years and really brought that investment management and active investment management presence to Australia that allows us today to offer active here that really wouldn't have been the case 10 years ago.
Sure. Okay, looks like we're up for time. So maybe just to recap, looks like both our panelists agree there's spaces in portfolios for both active and passive strategies. Cost is clearly important to all of you, but there is definitely room for both, and it's not kind of an either-or proposition. So with that, if you could please join me in thanking our panelists for today.